One renowned retirement expert and former Goldman Sachs banker is stepping forward and revealing his number one way to beat inflation. It's a way to receive a nearly 10% yield from the government with virtually no risk. Folks who take the 3 simple steps he's sharing right now could receive nearly $1,500 from the US Treasury in as little as a few months. Best of all, it's guaranteed by law, and you could pay 0 taxes on this low-risk investment. Consider how rapidly inflation continues to soar. You don't want to waste any time missing out on the potential profits he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to beatinflationreport.com. Again, that's beatinflationreport.com for a free copy of his new report.
Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is July 19th, 2022. Big show coming up for you. We're going to talk about the markets. A little back and forth here to kick off the week after a nice week last week. But Bitcoin holding up, a little bit of a rally. But finally, we're going to dive into 12 stocks. These are 12 stocks that Barron's anointed potentially the next Amazon. I'll give you my thoughts. And I got to tell you, get your pencil, get your paper ready. You got to write these down. All this and more coming up right now on Making Money. Again, thanks for joining me. This is Matt McCall. It's July 19th, 2022. It's a nice little Tuesday here in Baltimore. A little steamy for the Northeast. I thought getting away from Florida, I'd get away from this steamy weather, but boy, oh boy, it followed me right up here. Then again, it is the heart of summer. Well, I wish the markets were a little more steamy, to be honest with you. But I will tell you this. The action that I've seen over the last couple of weeks, I know we've had a lot to deal with. We've had the hottest inflation number in about 40 years. But I will say that there's something that I'm feeling more and more, and it's a negativity, which I've talked about in the past. How negative people are, but it's not really coming through in the market as much. We're continuing to hold those lows that we hit a couple weeks ago. And we'll take a look at the S&P 500 here in a moment. But my view right now is, I got to tell you, there could be one more swoon down. I've been saying this. I'm not trying to call the bottom. But the more negativity you hear, and with that negativity, the market doesn't break down to new lows. That brings you one step closer to that ultimate low. And keep in mind, folks, there's only ever one low in a pullback, in a bear market, in a recession. There's only one day it's a low. So you're not going to probably pick that. You need to get that sweet spot. And I took a plane up yesterday from South Florida to Baltimore for the week to come in the office. And I'll tell you, I just got done listening to books. I listen to books sometimes when I'm on a plane or if I'm running because I don't read all the time. And I read a great book I recommend. It's called The Psychology of Money by Morgan Housel. And I got to tell you, it is a book that, one of the better books that I've listened to, I say read, but I listened to in a long time. And he brought up a lot of great points. And what I want to share with you here, and just gives you an idea of the market. Actually, two that I want to share with, because I love numbers, I love stats. One was that the market has gone up 17,000x in the last century. Yet, he talked about newsletters. Doom and gloom newsletters will still sell every day and sell very well. That's amazing. 17,000x. And you'll say, Matt, well, I'm 70 years old. I'm not going to live to 170. I get it. And I'm not saying everybody out there is going to live 100 years from now. But it just shows you the wealth creation that the stock market has had. I'll give you a little bit of a newer example. Most of us know that follow the market, that Monster beverage, and make that sugary energy drink that I think will kill you. I think it's terrible for you. That makes that drink has been one of the biggest, if not the biggest winner over the last 30 or 40 years, depending on the time frame. If you go back on Monster, which is symbols MNST, from 1995 to the end of 2018, that stock was up 319,000% in energy drink. Okay, that's one, that's important. But the important thing here that Housel talks about, the statistic is, that stock, even though it was up 319,000% in 23 years, it traded below its all-time high, the previous high, 95 95% of the time. So that means 1 in 20 trading days, which is about once a month on average, the stock will be hitting a new high. So majority of the time, you're buying on pullbacks. And this is a pullback. This is a bear market. We know that. It's in the numbers. But within bear markets comes great opportunity. Crisis equals opportunity. Not all crises are the same. Not all opportunities are the same. But folks, I'm telling you, these types of numbers that you read, it really just gets you going. I mean, I look at it, it makes me even more bullish in the market. I'm not saying today or tomorrow, next week. I'm saying over the next 3, 5, 10 years of the roaring 2020s, I think there's just great opportunity in solid companies right now. Again, I'm not calling the bottom, but I was looking at a lot of charts with some of my colleagues and my team this week. And I got to tell you, there's a lot of great looking companies that bottomed in May and haven't come close to testing that bottom again. And I've been saying this for about 2 months now. I think a lot of good companies have found their bottom already. So I'll take a look here at the S&P 500 for you, just to give you an idea of where we stand right now with the markets. And as you can see here in the chart, and I talked about this last week, we're still in that downtrend. We still have lower highs, lower lows. And right here is channel. But then this is very short term. I'm looking about a 5-month time frame, not quite, about a 4-month time frame. I would much rather look long term. Look here, just looking out a couple years, where the S&P was, the SPY tracks it, 230. We're still at 380. That's from 2017 to now. It's less than 5 years. And we've had a lot of pullbacks. We've had the COVID pullback. We had the near bear market. We missed it by about 0.5%, late 2018. And now the bear market we're in now. That's just in 5 years, folks. So again, we have to put all this into perspective that the very short term, a lot of times it just throws us for a loop. And the stocks I want to talk about in a minute. And again, I have 12 stocks that I pulled from a Barron's article this weekend, which I think is I read it and I saw the headline. I read it. It's a very short article. You can read it if you want out there. Just Google Barron's 12 stocks. And it'll probably come right up. But I'm going to talk about them. But before I get into that, another asset class that has been up and down all over the place has been Bitcoin. Bitcoin's around 21,500 to 22,000 or so right now. But it did on Monday hit the highest level in over a month. And it's starting to look like maybe that formed a bottom as well. Ethereum, remember that, number 2, bit largest cryptocurrency. That came down to about 1,000. Now it's around 1,500, up 50% from the low. So we're seeing a big bounce back in some of these asset classes. And guess what asset class has done nothing the entire time? You're right. Gold continues to be garbage. And I'm only saying that for all the haters out there that hate me because I don't like gold. But I got to tell you, I've been right. So anyway, markets look like they're doing all right, but we need to break that downtrend line. Bitcoin, we break above 24, 25,000. I think we run to 30 pretty quickly. So we have some levels to watch. We'll update you, obviously. Every time we do a show, we'll take a look at those for you. But now I want to get into Barron's list. And as I mentioned, it's a pretty short article. Came out this weekend. They had 12 stocks that could be the next Amazon after a bubble bursting. So what they said in the article is they said, bubbles, after all, have popped for other big winners in the past, particularly Amazon. Amazon was down 95% from its December 1999 web bubble, tech bubble high. Back then, shares went for $5.65 a share. They pulled back to 28 cents a share. But since that low, the low didn't come till 2002. Amazon stock's about 36,000%, which if you do annual returns, about 34% a year, crushing the annual return of the S&P of 9% a year. At 34% a year, you double your money just over 2 years. Every 2.1 years, you double your money. At 9%, you double your money every 8 years. Compounding, baby. Compounding returns. That's why it's 36,000% return. So let me show you a little chart here I have of Amazon. And you'll see in this chart, folks, just the pullback that I'm talking about. As you can see right here, this is Amazon going back to the 90s. At several pullbacks, pullback 30%, 30%. We had a pullback of 50. Then we had a pullback of nearly 60. There's the 95% pullback we had. finally get back to a new high. And then look at this. So 25%, 30%, 30%, 30%, nearly 30%, and then down about almost 50, down 37% right now from the most recent high on Amazon. It's not abnormal to see some of the largest companies in the world, some of the biggest winners in the history of the stock market, suffer multiple pullbacks of 30 to 50%. It's just part of the action. So when you buy a stock, and you're buying a stock, let's say, for the long-term trend of it, a 10-year trend, it's going to take the time, whether it's genomics or electric vehicles, solar. These are trends that last decades plus, and you want to own it for that long. You need to understand there will be pullbacks of 30 to 50%. It's just going to happen. If it doesn't, somebody's probably lying to you because I can't see it being real. So what Barron's did is they screened for stocks that they believed were disrupting old industries and that were down at least 80% from its all-time high. So kind of similar to Amazon's 95% pullback it had from 99 to 2002. The 12 stocks they came up with are down an average of 86% if you average them together. That wiped out about $600 million in market cap. That's a big number. So in this list, let's go through, and this is in no particular order. I just kind of went through it as I saw them in a list and went through it. And we're gonna go through these pretty quickly because I don't want to spend too much time on every one, but I think it's important to kind of give you an idea of what they thought were disruptors, number one. Number two, why they pulled back, and more importantly, number three, where we look in the future. So let's take a look at number one here. Number one is Carvana. And if you don't know much about Carvana, they do online car sales. Obviously, this was huge during the pandemic because people were buying a lot of vehicles with their stimmy money, as they call it, stimulus money. It's now fallen down to a $2.4 billion company. I mean, this stock was above $360 a share. Now we're down to 22 and change. But revenue is still expected to grow in the next couple of years, 23% annually, with earnings growing 75% annually in the next couple of years. To give you an idea of revenue, I just told you it's a $2.4 billion company. But in 2020, let's go back a couple of years, revenue of $5.6 billion. Last year, $12.8 billion. This year, looking for $16.05 billion. Next year, 20.2. 2024, looking for $24.7 billion, nearly $25 billion. But based on just this year's estimate of 16, based on that, and based on the fact that it's worth about $2.4 billion right now, we could do the math. It trades at about 1.215 or so price of sales. So darn cheap. The reason for it is, one, car sales boomed, and they're not going to get back there anytime soon. So it's going to be declining. That's number one. Number two, more company specific, is the fact that they're still going to be losing money through 2024. And I don't see a path to profitability anytime in the near future. And that's concerning for this company. And there's actually a write-up recently. I don't know if it was a Wall Street Journal, I think this week did it. And it wasn't a very positive article on Carvana. So again, none of these are buy or sell recommendations. Nothing ever is. Just kind of giving you my thoughts on it. But this is one that has fallen that much that could bounce to 60 and be more than a double and still be well below where it was. The next one is a company a lot of people love, and this is Upstart, symbol UPST. The stock was about $400 last October. Now it's at 26 and a quarter. I mean, they're all going to look like this because they fell so much. This is a leading artificial intelligence lending platform, now down to about a $2.3 billion company. But again, looking ahead, revenue growth is supposed to be 20% annually, earnings growth 30% annually. And then we take a look at some of the numbers. In 2020, it had revenue of $222 million. Shot up last year to $846. This year, 1.1. Next year, looking for about 1.5. And it makes money. Last year, made $2.37 a share. This year, it's dipping to $1.43, back up to $2.11 potentially next year. So this is a profitable company, which based on, if you look at next year's earnings estimate, it trades at a P of about 12. So it is very cheap on that valuation. You look at next year's revenue, it trades at about 1.4 times sales. So this is a company that is in a very disruptive space, but again, has gotten crushed. Could this be a play down here? Possibly. But again, trying to buy anything down 85%, keep in mind, they mentioned this in the article, not every stock that pulls back by 85% becomes an Amazon. So I'm not saying that either. And I'll tell you how I'd play this if you're interested in stocks before I wrap the show, because it's very important if you're considering these. The next we're going to take a look at is Peloton, PTON. We all know Peloton, Connected Health, $3 billion company. And this was one of the darlings of COVID shutdown because obviously you're stuck home, so everybody's buying Peloton so you can work out at home. Couldn't go to the gym. $3 billion company, but they still see revenue growing in the future, 13% annually. Bottom line earnings, 73% annually. And you can see revenue going from 2019 to $915 million to last year, $4 billion. That was the COVID push. They still think, by 2025, around $5.5 billion. Well, I'm going to dip for a couple of years and get back up there. But very similar to a lot of these stocks right now, the reason they're getting punished, no path to profitability. Looking to lose about $4.24 a share this year after losing 5 cents last year. Don't see a path anytime soon when it comes to Peloton. The next we'll take a look at here is a disruptor potentially of the brokerage industry. And this is Robinhood, symbol Hood. This was obviously behind the meme stocks, Wall Street bets, all that kind of stuff. It's now a $7.6 billion company. Sees revenue growing 22% annually, earnings 29%. You can see here in 2019, they had revenue of $277 million. 2020, $958 million. Obviously, it was during the whole meme stock lockdown. Everybody's out there buying stocks. Last year, $1.8 billion, so nearly doubled again from the year prior. This year, dipping 1.46, $2 billion next year, and then about 2.4 in 2024. But again, losing money through 2024. Don't see it turning a profit anytime soon. I'm not a fan of Robinhood right here. But again, it's on the list, so that's why I'm doing it. The next is a buy now, pay later company called, they call that BNPL, buy now, pay later. So when you go to buy something for $100, hey, do you want to make 4 payments of 25? No interest. Sure. I don't do that, but a lot of people do. This is Affirm Holdings, AFRM, $7.1 billion company, growing revenue 25%, earnings 9%. 2020 did $509 million in revenue. Last year, $870, big growth. This year, looking for 1.34, up to 2.56 in 2024. But again, folks, what's the theme here we're seeing with a lot of these? Losing money through at least 2024, no path to profitability. That is what concerns me. Next is a crypto company. And I just mentioned, Bitcoin's having a bit of a bounce back, and this has been bouncing back a little bit here as well. And this is the leader, really, in my opinion. This is Coinbase, symbol coin, COIN. It's about a $13.7 billion company, expected to grow revenue 14%, earnings 52%. It did revenue of $1.27 billion in 2020. In 2021, last year, jumped up to 7.8. We're pulling back a little bit here. 3.9 this year, then 5.2, then 6. So still have some nice growth on the top line. Made huge money last year, $17.10 a share. Falling down, we're going to be losing money next couple of years, but we should break even around 2025, in my opinion. So this has a path to profitability when it comes to coin. But again, look at the chart here real quick. This has been forming a bit of a base where a lot of the others continue to dive down. This is one I would actually put on the radar down here because I still think cryptos are going to be much better than they're doing right now. And I believe as a leader, early leader, there's some upside to it. Next stock we'll take a look at here is Rivian. And this is an EV startup. But as a startup, it's still a $30 billion company. Symbol is RIVN. It was an IPO last November, ran up to $170 a share, down to 31 now. But again, look at this chart. Fell below 20, been forming a base down there ever since. And they have expected revenue growth next couple of years, 55%, earning only 11% earnings per year, and still going to be losing money for a couple of years like some of these others. However, two things. They're actually putting trucks out there. I saw one in the parking lot. I played golf on Saturday down in Florida. I was in the parking lot. Boy, it's a nice looking vehicle, I'll tell you that. They did sales in 2021 of $55 million only. This year looking for 1.84. Next year looking for 6.2 billion. By 2024, $12.3 billion for a $30 billion company. So if this company hits its numbers and keeps going and the product gets nice acceptance like it has, this is one you want to keep an eye on. That's Rivian. The next has to do with sports gambling, which I love. I love sports. I love gambling, all that kind of stuff. And this is DraftKings, symbol DKNG. I put this chart out, and you can see here, it says big move coming for DraftKings. I put this chart out on Twitter the other day. You can always follow me on Twitter, Matthew McCall. And it's a big move coming. This is what you call a triangle. When you have lower highs, lower lows, it's before it's called an asymmetrical triangle. If you break above this line, it's at it right now, folks. That's a major breakout telling me this downtrend's over. It's about a $5.7 billion, one of the leading companies for online sports gambling. Revenue expected to grow 25% on the upside, earnings 44%. You can see how it's taken off since they legalized gambling a few years ago, sports gambling outside of just Las Vegas. 2019, they did $323 million. Last year, 1.3. This year, looking for 2.1. 2 years from now, looking for 3.6 billion. But again, losing money through 2024 as they reinvest a lot of that in. I'm not as worried about this because I do see a path to profitability for this sector in general. The next one we're going to take a look at, we're getting through the list quickly. We're going through all 12. This is Ginkgo Bioworks. This was a SPAC that went public back in September. The symbol is very easy to remember, DNA. If anybody remembers what DNA was back in the day, the symbol used to be Genentech, was a high flyer back in the day, one of the original biotechs. If you remember that, I'm dating myself. $5.5 billion company. They program cells basically as easily as you can program computers. The platform is really market agnostic. It can be used in a lot of different areas, which is really great. 2020, it had a revenue of $76 million. Last year, $313. This year, $384. 2 years, $631. So revenue growth annual looking about 34%. Bottom line earnings 58%. And we should get close to break even around 2024. So maybe 2025-ish. So a stock that's fallen from $15 down to $3, it was below $2.50 at one point, and it's right around $3 right now. Very aggressive, but again, forming a base like a lot of these others out there. Next one is a spin-off from IBM, and this is Kyndryl Holdings. And Kyndryl, believe it or not, there's no vowels in it, just two Y's. And this is about a $2.2 billion company. And this does tech services and IT tech infrastructure services, cloud services as well. Again, spun off from IBM last November. And it should be profitable by about 2025. But if you look at revenue, it's about $16 billion every year around the same time. It doesn't see much growth there. I'd have to dive a little more into this because the spin-off a little bit wonky. But again, that was on the list that came out here from Barron's. We got two more on their list. One is it's a play on Metaverse. It's Unity Software, symbol U. They recently came out last week and said they're buying IronSource, symbol IS, which it used to be a SPAC. It's about a $10.7 billion company. Sees top line growing 22%, bottom line 11%. You can see here in the chart, it actually fell on the IronSource deal. They thought they paid too much for it. I do not agree with that at all. 2020, the revenue is $772 million. This year, looking for 1.37, about 2.3 2 years from now, and expected to turn profitable in 2024. It is a leader in Metaverse, profitable. We have a path to that 2024 stock I like. And then the last one on the list is DocuSign, DOCU, about a $12.7 billion company. Revenue growth about 12%, earnings 57. DocuSign, again, got big during the pandemic because obviously everybody was signing things online. 2021, last year, about 1.45 billion in sales, looking for 2.1 this year, and not growing that much going forward. As I said, revenue is 12%. Earnings, though, from $1.98 2022, dipping to $1.71. So again, not seeing huge growth when it comes to this. You can see the chart has been struggling as well as charts of most of these have. So I'm going to wrap it up there, but I will tell you one thing. The way that I would look to play this, if you say, you know what, Matt, I think two of these are going to be 10 baggers next couple of years, and they very well could be. Or I think one of these is going to be an Amazon 36,000%er in the next 15 years, let's say. So you think about that, the 11 could go to zero, and one could go up 36,000%, and you still make boatloads of money. I mean, fill this room with money. So if you do it, you can't pick one of these. And again, none of these are buy or sell recommendations, but if something in your head says, you know what, I trust Barron's, I like this list, you split it evenly between 12. That's how you have to play a lot of these. You have to take the basket approach, which I implement all the time, but that has to be implemented, especially in a situation like this, folks. You cannot try and pick that one because the odds of you picking the one that's going to be the biggest winner is 1 in 12. We know the math. It's not very good. So please do that. Always diversify, always look for baskets, and don't put all your eggs in one basket. So thank you so much, folks. Let me know if you like the show with a lot of tickers like this. I like to get through a lot, and I thought it was good to go through this article in Barron's because I think a lot of people saw it, and I just get my 2 cents on there for you, my unbiased 2 cents. Again, nothing here buy or sell recommendation. But thank you so much for supporting the show. Thank you so much for watching. Like, comment, share, all that good stuff. Keep your head up. We'll be back in 2 days. I'm bringing one of our favorites here at Stansberry for a great interview. You're going to love it. Coming up on Thursday's show. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
opinions expressed on this program are